Hello, everyone, and welcome to this session on developing regulation, sustainable assets, and financial markets. I am Danai Kyriakopoulou. I'm Senior Policy Fellow at the Grantham Research Institute on Climate Change and the Environment at the London School of Economics and also at the Advisory Council at OMFIF. Well done to all of those of you who've stayed with us for these past 2 days. This is now one of the last sessions, but last but definitely not least, in terms of interests, it's a great pleasure to have with us today two great speakers focusing on the US side of sustainable development and climate change management. So we have with us Patrick Harker. Patrick is the president of the Federal Reserve Bank of Philadelphia, and he's been at that post for a while. He was also in the previous life university dean, and he's an engineer by training. But he's discovered that by economic policy, you can make a greater impact on the climate, perhaps. We'll discuss that. And also Steve Rothstein, who's the founding managing director of the Series Accelerator for Sustainable Capital Markets and was also one of the founding team of Citizens Energy Corporation, the world's only not-for-profit oil company. So welcome to both of you. Look forward to our discussion. So let's start by reflecting on what we heard earlier this month at the UN General Assembly. President Biden made a commitment to increase climate finance, and we've also seen climate be a big item on the agenda for the Biden administration since it took office. And of course, the Federal Reserve has joined the Network for Greening the Financial System as well, belatedly compared to other central banks. But America is back when it comes to the climate stage. So let me start by asking both of you, what do you think will be the implications for the economy of increased climate action? And how does this make these actions relevant to your own institutions? So Pat, let's start with you.
Yeah, thanks. Thanks so much tonight. Thanks for everybody for joining us. So I'm really looking forward to this discussion. We've got a lot to discuss in a short amount of time, so I'll keep my remarks brief right now. So I know this is a global audience, so good morning, good afternoon, good evening, wherever you are. Thank you for being with us. So I want to be clear from the outset that the views I express today are my own and do not necessarily reflect those of anyone else on the Federal Open Market Committee or in the Federal Reserve System. So I also want to be clear, the Fed does not do climate science, right? That's not what we do. In my previous life, as Danai said, I was a university president, heavily invested in climate and energy sciences. We don't have climate scientists on our staff. And as with fiscal policy, social policy, and a host of other issues, the Federal Reserve does not seek to determine US climate policy. That is the role of elected representatives. And I think often in the public and in the media, sometimes that gets confused. So I want to make that very clear from the outset. So what do we do? What we do is important work in quantifying and analyzing risks that climate change could pose to the US financial system and the global financial system. Our strength here is really in our research, our analytical financial research. To that end, the Federal Reserve has created a Supervision Climate Committee to build capacity to identify and assess the financial risks posed by climate change, and to promote the resilience of supervised institutions to climate-related financial risk. We can get into that as we go along. The Federal Reserve has also created a Financial Stability Climate Committee to identify, assess, and address climate-related risk, specifically related to financial stability. So we view climate-related risks through our existing mandate of safety and soundness of the financial stability. It's square in our mandate. It's right in our wheelhouse. So I'm really looking forward to this discussion, and particularly with the theme sustainability, because I think that encompasses a number of factors beyond climate. You know, climate is one thing we're going to talk about, but an economy that's sustainable, in my view, requires a lot of things: competition, accessibility, effective education, high quality infrastructure, skilled workers. The list can go on and on. To have a truly sustainable, resilient economy it's a big, tall order. But I think we have some sense of what that is. So I'm looking forward to this conversation. Let me turn it back to you tonight. Thank you.
Thank you very much for being so clear from the outset on the role of the Federal Reserve, and it's something that we've discussed before as well. And we had a very good conversation on that together and also with President Bostic. Now, Steve, let me turn to you. How does the U.S. Climate commitments affect the U.S. economy and also your institutions' operations?
Well, thank you to you, and it's a pleasure to be with President Harker and all of our colleagues around the world. President Biden has said, and we agree, that climate is an all-of-government issue. So it's not just the EPA. Yes, the EPA does policy, climate, environmental policy, and the Federal Reserve does not, and I completely agree with that. But this affects all of our lives, and there is no bigger risk than climate issues. It was just actually a recent survey of over 3,000 insurance companies that came out last week, and they identified this as their single biggest risk that they feel, more than even the pandemic or cyber or things like that. And it's both a risk and an opportunity. First, on the opportunity side, it is projected now that the world spends about $150 billion a year in emerging economies on climate mitigation, climate solutions. It's projected that 150 billion needs to go to close to $1 trillion a year to get to our goals. That's enormous opportunity for growth and opportunity for jobs and growth in that sense. There is also no bigger risk. And whether it be last summer in the same week that China faced floods and Germany did, or earlier this month in the US, we had in the eastern part of the country enormous hurricanes and disasters, tens of billions of dollars of economic loss, 81 lives lost. At that same week, in the western part was fires and droughts. So these are risks that are with us today and opportunities with us today. So it's enormous on both sides that we all have to work on it. And just on the Federal Reserve, I completely agree with what President Harker said, that this is squarely in the mandate of the Federal Reserve. If you look at the safety and soundness of a bank, if you're a regulator or if you're a bank leader, you cannot do your job if you don't factor this in. Climate issues and the broader areas of sustainability. We in the United States and unfortunately in many parts of the world, there are racial injustices that have gone on for decades or hundreds of years. And we need to look at opportunities to address these. And the climate is very much connected, that where there are bigger environmental issues, there's also greater environmental justice. If you look at places like Katrina in the US, the people who are hurt the most are the people who have the least economic area. In the United States, half the people, if they had a $400 surprise expense, they couldn't survive. So if their water heater flooded, or they had to go because of a climate emergency. So we have to look at the climate issues, but also look at the racial justice as part of it. And the role of the Federal Reserve and other agencies are critical in that area. I'll turn it back to you, and I'm very eager to have this conversation.
Houston, I.
Thank you.
There she is.
You spoke of the opportunities. You also spoke of the risks. You also spoke of the risks. And I want to ask about the risks to President Harker, because that's something that central banks care a lot about. So how worried are you about the specific risk of climate-related stranded assets? Because here in the UK, we're going through some sort of an energy crisis, and can climate transition be the cause of financial and price instability? And if so, how can this be avoided, and what is the role that central banks can play?
Yeah, I'm actually worried about two types of stranded assets. One that gets a lot of attention, that is the hard capital assets that we have. But there's another that I want to talk about. On the stranded capital assets, this is clearly a risk, but I think it's one, if we're thoughtful about it, we can manage. I mean, it is not a risk that we don't see coming. Right? We clearly see it coming as we move to alternative forms of energy, for example, and new technologies more broadly, not just in the energy area, but the old engineer in me, the old civil engineer in me, keeps coming back to a very basic commodity we don't know how to deal with, concrete. I mean, concrete is a major source of greenhouse gases, and we really don't have technology yet. But I'm also an engineer scientist in the sense that I think we can innovate our way to better solutions. So we're going to have stranded assets, not just in the energy market, but potentially in other major sources of greenhouse gases, like concrete, steel production, and so forth. But again, we can see that coming. The one that doesn't get any attention, I want to highlight here, is human resource stranded assets, right? So this is one where I can speak for at least my own view in the US context. We typically don't do a very good job of making that transition. So as we make this transition, and in most extreme case right now, and we'd love to hear Steve's view on this, is coal. As we move away from coal, which we've been moving away for economic reasons now for a while, this puts a disproportionate burden on those communities that were relying on those industries. And we really don't do, I think, as good a job as we need to, reskilling that workforce, dealing with the geographic mismatch. It's not just the skill mismatch, but it's the geographic mismatch of people being in the wrong place for those jobs. And that in turn feeds on itself, causes some of the political strife and the completely understandable anxiety that people and families have with this transition. Again, I think we have an opportunity now to really approach this whole shift to a different form of energy and more generally production of some basic commodities in our society. We have some time to think this through and put in place the training programs. This is an area for the Philly Fed, for example, we're very involved in terms of skill-based training, particularly for those jobs that where you don't need a 4-year college degree. We call them opportunity occupations. These can be good, life-sustaining, family-sustaining jobs. It's that stranded asset that I'm worried about, because that stranded asset is us. It's our fellow citizens and global citizens. And it leads then to the political problems that we often have in making this transition. We need to think this through, and then we need to execute.
Thank you very much. And thank you for putting such emphasis on the aspect of jobs and opportunities as well in the transition. And you use the words transition and that it's a shift, and that is something that takes time. So let me just follow up on that, because there's questions of how much do we need to endure until we get from A to B, and what is the kind of sacrifices that we may need to make, or do we not need to make it then because there are opportunities. So some people, for example, have expressed concerns that the climate transition, and particularly the energy transition, may generate greenflation, because while you need to manufacture all of these renewable sources of energy, a lot of the inputs that are going into that use themselves or rely themselves on fossil fuel industries or industries that pollute. So for example, it may not necessarily be the energy side, but the concrete that you need to use as an input to create wind turbines, for example. So do we need to worry about that, or is that just part of the equation from getting from A to B? How do you see that issue?
I think it's part of the equation of getting from A to B. I mean, we and the royal we is, I think, both policymakers on the government side globally, but also the private sector. We need to come together and come up with solutions and that are pragmatic. I mean, as we make this transition, for example, at least to the best of my knowledge, I don't think we can make this transition without new innovation and new deployment of not just wind and solar, but also nuclear power. I mean, that has to be an integral part, and it's a big debate, right? Do you call nuclear power green or not? But I think if you just do the math and add up what we need to produce, and Bill Gates's book does this, and many other analyses, you just can't get from here to there without some innovation in that space as well. So I think we have some time, as I said, to do this, but not a lot of time. I mean, this is one where we have to start taking action now. The private sector is starting to take action. That's the good news. If it was supported by good policy, we could accelerate this process. And again, this policy is not Federal Reserve policy or central bank policy. It's really on the fiscal side of the house.
Thank you. And Steve, let me turn to you now. And I want to ask you some questions about the kind of risk management practices that financial institutions face. But before that, give you the opportunity to respond to what we've heard from President Harker, and particularly, I think, the interesting comments of what is the right energy mix as we transition. How do you see that for the case of the US and the work that your institution has done in terms of should nuclear be part of the mix? How much should we be looking to in terms of the reallocation of energy sources?
Right. So a lot of great points. First, on the question of stranded costs, it's important to get a context of what's at risk for the banks today. We've done different reports. Lots of other folks have. We did a report a month ago on physical risk, about last year on transition risk. We only have access to the syndicated loan portion, but we took the same methodology that the European Central Bank did, actually used the same firm and did that analysis. That analysis highlighted that there is $750 billion, just again, the syndicated loan portion of the largest banks, and these are worldwide banks, but the ones based in the US, $750 billion of exposure based on either physical risks or climate risk. Half a trillion one time because of transition, and $250 billion a year on physical risk. To put that in context, when you look at the whole balance sheet, that's more than was exposed because of subprime housing. So there's reason to believe that there is more potential risk on bank balance sheets because of climate than subprime housing. So that's really important, and that's an example of the urgency to move fast. In terms of, and investors are calling for this. Today, we're an investor network. We represent the US, but there are folks all over the world that we work with. Collectively, investors representing $43 trillion, or half of the assets, of the worldwide assets managed, have asked for net zero by 2050, specific plans by science-based targets by 2030, mandatory disclosure, and they're asking the companies that they invest in. So this is an investor voice, and that's growing more loudly all the time in terms of that piece of it. I completely agree about the human stranded costs. We do have to have training. And this is a great example where if we wait until the crisis is even more upon us than it is today, we won't have that time. We won't have the time to put in retraining opportunities. So there are about 300 coal plants that have either not been renewed or have closed or in the process of closing in the US alone. And that's because of the economics, that they can't get financing, insurance, and the price of that. And so we do have a special obligation to people who are going through that transition and communities. And there's great work being done in some of these areas. So for example, in the steel industry, there's a group called Responsible Steel that's looking at doing a net zero steel. I was just talking to a cement company the other day that is the first one to announce they will have a net zero line of cement. It's more expensive, but to go. So there are, again, if there is time, even the heavy manufacturing can transition to that piece of it. So we have to go faster. And if you look at what's happened in the last 5 years, we've never seen so much economic growth. But if you look at the next 5 years, we have to exponentially increase it to go even faster because of the risks that we have. Last year, to give just one snapshot, during the pandemic, the large oil companies wrote off $145 billion of stranded costs because of change in demand. And they didn't just write it off because, oh, we're going to the pandemic alone and they'd get it back. They wrote it off because of that piece of it. Or President Harker's colleague in Dallas, they did a report on climate risk because Dallas had 200-year floods within 4 years, not within 200 years, within 4 years, and the economic loss, and those go on and on and on. So there are enormous areas there. And I do think we need to have an energy mix. I understand the need for that, and I think that there can be, obviously we have to push as hard and as aggressive on renewables as we can. We have to, and we have to reduce our emissions, do as much on renewables, and then look at others. And maybe there is some newer technology on nuclear to look at, but I wouldn't want to do that until we've really exhausted everything else. And there are some exciting new technology. I mean, solar and wind have come down by over 90%. And in the US, there's literally debate, literally today, about infrastructure and will we be investing in 500,000 charging stations around the country, and the impact there. The car companies have committed, or several of them, by 2035 to be all EV fleets. So there's more work to be done in those areas. So reduce as much as possible, use renewables, and to throughout all of this, think about the environmental justice areas.
Thank you. Full order there, but I think what you were saying also about some of those net zero options being more expensive is also the question of whether they are more expensive or whether the non-environmental options are properly priced. And I think that needs to be communicated very well as well. But of course, we need to look at the incentives. Now, you were talking, Steve, about the expectations from regulators, the disclosure requirements, some of the risk assessments that private financial institutions have to make. And there is a lot going on. Central banks around the world are developing new instruments. You mentioned that there's studies being made about the risk assessments in Dallas and elsewhere. That also here in Europe, we are seeing central banks put in place climate stress testing and scenario analysis. And we heard earlier from President Harker, the committees and the groups that the Federal Reserve System has also set up to explore the importance of climate risk in supervision practices. So how can financial institutions best prepare, and what further direction and guidance would you like to see from the regulators? We have one central banker here on the panel. What would you like to say to him?
You're exactly, I mean, the financial regulators, if you look at the countries that are leading on climate areas, in all of them, the financial regulators are involved. I completely agree that they don't set certain policies. There is important work for their administration, for their legislative bodies to do, and other regulators, but they can't do it without financial regulators. So three things. First is that under the assumption no business can manage what it can't measure, you have to understand what's happening, whether it be any problem, and we can't measure without consistent mandatory climate disclosure. We have in our country and around the world, financial disclosure has been in place. When the Securities and Exchange Commission was established in the US 87 years ago, there was a bargain set with folks that there'll be a free and open and robust market, but then there'll be good financial information. Going forward, investors can only make decisions if there's also good climate information. So it's not the Federal Reserve specifically, they have some role, but it's much more in the US, the Securities and Exchange Commission, to focus on disclosure. And there's a process going on now with the SEC, and I could talk more about the specifics of what we hope to have that. But so disclosure is one. Second is to look at the work that President Harker mentioned is great about the committees and the research. I'll give you an example. Last Friday, the New York Fed issued a research paper, again, not a policy paper, but a research paper on climate stress tests. It's very and that highlighted just Citigroup as an example. There's a potential exposure just from Citigroup, from one bank, of $73 billion. So more research, more analysis, but we believe there should be climate stress tests, just like many other Europe and other countries are doing this. The first year or two, they should be non-binding, meaning it shouldn't affect the capital reserves to understand more. But over time, that if you think about a bank, and if two banks, one has riskier loans, they should have a higher capital reserve margin. So we need to have that. So climate stress tests. And the third is lots of coordination. And again, I appreciate that the Federal Reserve has joined NGFS, and there is coordination with IFRS. I mean, there's a lot of international bodies on the disclosure and the bank supervision, coordination within the country. We, unlike many other countries, have a lot of bank regulators, four at the federal level, and every state has a bank regulator, coordinate with others. So lots of communication so that there are clear signals. So disclosure, price that in terms of climate stress tests. There's a lot of other operational elements of supervisory and monetary policy, and communication and coordination.
Thank you, Steve. Patrick, let me give you the chance to respond to that. Are these the things on your to-do list?
So, as I think the people who are here are aware, the US's financial regulatory structure is complex. That's an understatement. And I think Steve is right in the sense that with respect to microprudential regulation, that is what we do with an individual institution, we are actively looking at climate stress test models, and he mentioned one paper coming out of New York. There's other work going on in the system to really try to understand how we would do this, what exactly we would do, and that's within the regulated banking system. There's another big piece of this, though, which is on my mind a lot, which is the macroprudential aspects of this. That is financial stability issues, because much of what is going on is, for example, an insurance company. Steve mentioned the insurance risk. Well, that's outside the purview of the Fed per se, and it's a more complex issue in dealing with the regulatory structure of not just the insurance industry, but the shadow banking industries more generally. And there, we do need a concerted effort. And this is where I'll go back to Steve's point, a whole government approach to really trying to understand how all the different regulatory bodies can come together, understand the risks, and put in place ways to, I completely agree with them. This is why we're doing this research, to measure them and to put in mitigation efforts through our supervisory function. And we're starting, this has already started even before, and I think it's important, even before we have a stress test model or anything else, our bank examiners on the ground are going to talk to banks all around the country and saying, do you understand your risk that are in your portfolio? How are you mitigating those risks? And that's having an effect. So before we get the headline activity of broad and sweeping regulatory change in the US around climate, the day-to-day conversation we have with bankers, particularly community bankers, smaller bankers throughout the communities. I'll give you one example. I mentioned this earlier to Steve. So when I was the president of the University of Delaware, Delaware is unique in the United States. The whole state is a coastal zone. I mean, it's a very, so we were already seeing saltwater encroachment into the farmland in the state. So the banks in the southern part of the state have to understand that risk, to those loans to those farmers, that some of this is coming out of production. The land is coming out of production. So they are already aware of this. And we as regulators are working with them, trying to understand that risk. So I think that will continue. So it's not like we're doing nothing. In fact, I would say those conversations are having some effect because, and particularly after this tragic summer where we've seen these wild swings in weather and the real cost of all this, you can't avoid asking these questions as a bank examiner. If you're putting loans out to communities that are susceptible to fires, and we've seen the tragic results of that. So there's a lot going on, and we need to keep pushing in this area. And I don't think we're done by any stretch of the way. We got a long way to go, but I'm actually cautiously optimistic that I think things are moving in the right direction.
Thank you. That's reassuring in terms of all these conversations happening at the very local level as well, because you mentioned the complex regulatory landscape in the US, but it's also the kind of climate risks and what are material to different parts of the country is also very heterogeneous. And that's the question of materiality, something that a lot of regulators are looking very closely at, because yes, CO2 emissions are going to be the same everywhere. But when you look at the impact on the environment, depending on whether it's a region susceptible to fires or coastal states, as you mentioned, will have very, very different exposure to risks. And how, as a regulator, do you build those into stresses that need to have convergence in terms of the standards? That's another question. We had a panel earlier with central bankers from the UK, France, and Brazil, and they have already conducted stress testing exercises or are in the process of. And one of the things that came up is, what do you do once you have the results of the stress testing exercise? Because it's all good to have a risk assessment and to know what is the exposure in your banking sector, but then do you take action on that as a regulator, and what action do you take? These are all very important questions. Steve, you spoke about the coordination across agencies, and we heard from President Harker also about the complex regulatory system. So I wanted to ask you about, because we've also heard from the Treasury earlier today. We had a session with John Morton, who's the Chancellor to Secretary Yellen on climate and leads the Climate Hub. And we saw that very clearly in the COVID crisis, that a lot of agencies from across the US government and wider policymaking system were coordinating very closely to address this crisis. How do you see that in the case of climate, and how do you see the role of the Fed in the context of other regulators, not just kind of fiscal monetary interaction?
It is, because it's such a complex issue and the US has such a complex structure, as President Harker said, we have to all be very deliberate about this. So, for example, there is a group now within Treasury, the Financial Securities Oversight Council, FSOC, that is working on a report. The President Biden has an executive order, and that's due in the middle of November. And so there are 15 agencies included. Now, some are independent, like the Fed, and some are more within there. So one of the ideas is that we've recommended that there should be a data source that's used across the government. There is a data source on financials. We use GAAP, and we look at income statements and balance sheets, whether you're the EPA or housing agencies, look at the same financial data. So, but now there are many different kinds of climate data. In a sense, we have a climate Tower of Babel because we're comparing apples and oranges. So there needs to be coordination, and it's not going to happen tomorrow, but work towards a baseline information. And there are great tools out there, TCFD and SASB, and there are great tools we can build on. So common data is important as part of that. It is also to look at coordination in the US with the state regulators. They play a critical role, particularly on the insurance side, also on the banking side as well. But we have in every state a securities regulator, a insurance regulator, a bank regulator. So that coordination to look at those areas. And just on the banking side, obviously between the credit unions, the large banks, the small banks, President Harker was talking about those. In some ways, the large banks have a maybe greater risk because of transition, but the small banks may have a greater risk because of physical risk, because they tend to loan in a geographic area. Mm-hmm. And so if there is, God forbid, a fire or a flood or a hurricane in that area, it could affect them in many, many areas. So we have to have more data, but it's very important that we shouldn't let the perfect get in the way of the good, meaning we have a lot of good data now on climate. We can't wait to get perfect data. Just like last year during the pandemic, people said, oh, we don't have perfect data on pandemic, let's not take any action. The Fed and many other agencies across the world took the smartest action based on their information. And as we learn more, we amend that action. The same on climate. We know more about climate risks than we do on cyber, about, God forbid, whatever the next pandemic or things are now. So we should use that. So common data, but don't wait for that. And then also coordination internationally. As you said, there are some colleagues around the world, and many that are listening, that are ahead. And to look at what their methodology has done. I'll give you one example. So the French central bank established a mandatory disclosure regime for certain classes of business in 2016. They went back and looked at the end of 2020. So after 4 years, the impact for investors for that disclosure, not divestment, just disclosure, that reduced those investors' investments in fossil fuel by 40%, or 28 billion euros. So what that says is disclosure has a big impact on people's information. That just as when people know more, then investors can make decisions, regulators can, customers, employees. But right now there's an asymmetry of that information.
Thank you, and thank you for your point about the data. And in fact, we've just published a report at OMFIF on the forward-looking data, and it was exactly that conclusion that we shouldn't make the perfect the enemy of the good, but of course the good has to get better, and it's also getting better. We are seeing a lot of progress there, and that was also the conclusion of the NGFS report, Adapting Central Bank Operations to a Hotter World, that the opportunity cost of inaction may actually be greater than the risk of acting with imperfect information. So it is a a balancing act there. But Steve, just now towards the end, you mentioned the coordination with other central banks, learning from each other, and of course the NGFS is a good forum for that. But Patrick, let me ask you, how have your interactions been, and what do you see as the optimal level of convergence when it comes to interacting with other central banks? Because as I was saying before, there's different questions of materiality, what is appropriate to different jurisdictions and so on.
So just in terms of structure, that tends to reside in the Board of Governors, not within the reserve banks per se. That said, I think the coordination is getting better. It's not perfect, but it's getting better as we're a little late in terms of some of the work we're doing. We're talking about stress tests. We're just starting that work, really understanding through our modeling. And so I think some of the coordination is just learning from some of the central banks who've already built things like stress tests, what worked, what didn't, so that we don't have to reinvent that wheel. But there's lots of other work that I think is in front of us, where the mechanisms for sharing information are getting better. Again, not perfect, but we're working on them.
Great, thank you. I would now like to open it to the audience, and we have some questions already coming in. And actually, one is linked to something that we discussed before from Javier Pujos, who's CEO at XP49 Limited. And he's made a comment about we shouldn't forget to think about the human stranded assets in countries entirely dependent on commodities, fossil fuel, or other brown processes. So you mentioned President Harker before about the human stranded assets, and that of course has an international dimension as well. There is
Absolutely.
a just transition internally, but it's something that crosses borders. So did you have any comments on that?
Again, it's outside the internationally, that's outside the role of the Fed per se, other than I can speak as a citizen. You know, you look at what's happening with people migrating worldwide from places that have become very tough to live in because of climate change. That's going to get worse unless we deal with this. I mean, these global conflicts are not going to abate because people are going to do what they have to do to try to survive and have their families survive. So we just need to recognize that, and we need to figure out a way as an international community. And I'm not speaking as a Fed person, how to help minimize the pain that people are going through as they lose their farmland, for example, because it's just not arable farmland anymore. Within the US, we have that same issue, not so much in terms of internal migration, but coal jobs are going away. They've been going away for a while. Other jobs are going away. And we've got this mismatch geographically, right? Where communities that once were thriving communities because of an industry, whether it's an energy industry or another industry, that industry went away. And we've not had a good history in the US of figuring out ways to deal with that in terms of policy. We just haven't. I mean, and this is a chance for us to get this right, in my view. And that means both figuring out how we can incent firms to locate in places where there are workers and make sure those workers have the skills necessary to do that work. That's a big challenge in front of us. And again, I wish it were not true, but if we had a track record of doing this perfectly before, I wouldn't be so worried, but I'm actually quite concerned about it right now. But again, this is something we know how to do. We just have to execute on it. This is not, again, we don't do this at the Fed, but I think we've learned enough over the course of many decades of how to do this workforce development right and how to do public-private partnerships right. And we in the Philly Fed have done this really across the Federal Reserve System. We've got a deep bench of understanding of this. It's now time to put this into practice.
Thank you. And you referred earlier to the work that you've done at the Philadelphia Fed on this in terms of the reskilling and the what human capital you need to deliver on the infrastructure projects as well. Could you tell us a little bit more about that work that you've done? And I remember before we've discussed about some examples as well. That was very interesting.
So actually, you can go on our website and there's a tool called the Opportunity Mobility Explorer. And it enables you to look at where you are now, what skills you would need to acquire that are like jobs. So not starting from scratch, but this is what I do now. How can I move to a better paying job? And actually several steps ahead. And then from that job, where can I go? And then from that job, where can I go? So it's a 3-step process. That tool's there. You can see by geography in the US, we have it broken down by geographic region, where those opportunities are for you, how much you would see an increase in salary, and what you would need to do to get there. Again, it's not like you have to go back and be completely reskilled. I mean, let's be pragmatic about this. I'm a pragmatist. If I'm 40 years old and I've got a family, I can't take a couple years to go back to school necessarily. I've got a family to feed. So pragmatically getting the skills you need through certificate programs and other programs to get that new job. We have that tool. So I would encourage people to look at our website. It's a very powerful set of research and a very powerful tool to lead people, and not so much individuals, but planners within a certain community, policymakers in a certain community, say, where should we invest, right? In taking the skill set from here to there. And in some cases, it's surprising, some of the skill sets that are transferable. You might not think, they're not obvious. Let me put it that way.
Thank you. Steve, what are your thoughts on some of these questions about both global justice and also within the US itself in terms of the just transition? And we should try and put some link to the resources that you referred to, Patrick, on the system. I don't know if we can do that, but I think that would be of interest to people.
Yeah, no, it sounds like there's a lot of great tools that are very helpful the Philadelphia Fed has. So appreciate, Patrick, your leadership there. First, internationally. Last year, if you take all of the people who have died due to man-made, whether it be gunshots or wars or things, the number of people who died due to climate-related issues are 3 times that, 3 times that. And that number is growing. And unfortunately, who's most affected? It's folks from low and moderate income communities and countries and areas, whether it be in urban areas or rural areas. So this is making the income gap even wider and adding to those. So we society series, we have a whole program about this, and but we're a small nonprofit, and all society needs to address this. We have to look at this in everything we do. So, and there are countries, again, that are really harmed. As I started earlier, there's also a big opportunity because we as a world need to invest a lot more in renewable, and there are many emerging countries that if they can skip going through the steps that we went through from fossil fuel to then renewables and go right to renewables, just like countries skip landline phones and run right to cell phones, they're able to help their economic growth in that sense. In the US, there have been studies that show if we do not make significant changes in our economy, we will face tens of millions of climate migrants from within the US, meaning people who live either in areas because of fires or droughts. Just right now, in the western part of the US, we're facing droughts. That's affected the water table. That's affected the hydroelectric capacity. So there's a 13% reduction in hydro capacity now. And unfortunately, as we have less snow and more droughts, that's just going to go down and down, as well as people not having enough water. We have a whole program and series about water. And as challenging as the climate issues are, water in some ways are even more exaggerated because you can't move them. I mean, there are areas that are water, literally deserts, and those are getting worse and worse. So climate migrant is an enormous issue worldwide. I've just talking to the ambassador from Barbados to the UN, Aubrey Webson, who chairs the small island nations at COP, and there are literally countries that are at risk of exposure. So we as a world have to do it from a humanitarian perspective, but also from a fiscal perspective. We saw at the beginning of the pandemic how the impact on the supply chain, the famous toilet paper problem. Well, we're facing that now across the area. I was just listening to a report the other day on cement shortages and paint shortages. And so we have to do that again. If you're a bank or a regulator, it affects the economic stability, but also affects the livelihood of our future. That's why investors worldwide have said we need to make these changes. We need to have them, again, not just for 2050. We have to have a year-by-year science-based target to get to 2030 as part of that.
Thank you, Steve. And yes, I was also looking at the Alliance of Small Island States, the declaration that they made recently, where they were also making comments about the uneven balance between climate finance going to mitigation versus adaptation. Because even in the best case scenario of meeting the Paris Agreement goals, a lot of these small island states will still have to spend a lot of finance in terms of adapting to that increase itself. So that's very important as well. But we've been talking a lot about risks, and I have a question now from the audience about sustainable finance and scaling up capital markets contribution. So Patrick Flynn is asking, with regard to the development of sustainable assets, could these qualify as collateral, be included under QE programs in the future? So what is the thoughts around including and perhaps changing the balance in sustainable assets in asset purchases? This is a very active debate here in Europe with the European Central Bank, for example.
Yeah, so in the US context, our QE program is very narrow, right? In that we purchase US treasuries and mortgage-backed securities. That's it. And so we're unlike some other central banks in terms of the breadth of the asset purchases. I don't see that changing, frankly, anytime soon, because in that environment, we're not allocating capital. And some people would say that you're allocating capital. I think our view, and I can just speak for myself, my view is that is not the role of the Fed. Our mandate's very clear. And we're not supposed to be picking winners and losers in the economy. That's up to the fiscal side of the house. They can choose to do that, or they can choose to change our mandate. But given our mandate is maximum employment and price stability and financial stability more broadly, I don't see our QE program, at least I would not be supportive of it changing, because I think we need to keep it as narrow as possible. In fact, I could see at some point supporting a treasury only balance sheet. But we're not there right now, but that is a plausible argument in my mind.
Thank you. And Steve, what are your views, perhaps looking at this more globally, because other central banks do have corporate bond portfolios as well. And the question there, you mentioned President Harker about picking winners and losers. And one of the comments has been that it's not so much about that when the risk is not accurately reflected in some of those sectors, which are perhaps considered to be certain investment grade by the ratings agencies, but do not reflect some of the risks that assets may have in terms of the climate risks being incorporated. So what are your thoughts on that, Steve?
Right. First, I understand that the US Federal Reserve's policy is different from other countries. I hope that there's a little more flexibility in the future. At first, we hope at some point that the price of carbon is built in, whether it be a carbon tax or a price, something to that effect. That's not the Federal Reserve's job, that's the policymakers. So I understand, I'm not saying the Federal Reserve, but policymakers. When we hope that does come in place, and when they do that, they look at the just and inclusive society, because right now, carbon tax, if it's just put in, it'll affect people most proportionally at the lower end of the income. So we have to address those. So to build in the real price, because we don't have that in. Right now, I think the Federal Reserve, for example, in the pandemic did a lot of great things, but they had one program with the oil companies where I think they underestimated the risk, and there were too many loans. So I think on that one, again, it's a very narrow program, they did put the thumb on the scale a little bit by undervaluing the risk of the oil companies and some of those loans. Hopefully they all work out financially. But I understand we're not Europe, but I also think that going back to the SEC, when we have, which I hope we do in the next year, mandatory disclosure for the real economy, for all publicly traded companies, then that will then people can understand if there are 5 cement companies, they can look at their GHG emissions by ton or by agriculture, and then we can make decisions. So I think that by combination of what the SEC can do, as well as the Fed, as well as the policymakers, I think that we can provide this. As we say, we're not going to get out of this just dealing with the risk. We have to look at the opportunity, and there's enormous growth opportunity in the infrastructure package being debated. There is enormous areas, whether it be on weatherizing homes or on building EV or on carbon capture technology.
Thank you. Patrick, how does that future that Steve has painted look to you? Does it look plausible in terms of when we have the data for being able to differentiate across cement companies? And I may add to that, Steve, that it's not just about the static picture of how much are their greenhouse gas emissions now, but also what are their transition paths and the kind of forward-looking risk assessments, because you may have company A and company B that have the same impact on the environment right now, but one is actually doing a lot of things to reduce that in the future. So it's even more complicated. But Patrick, your thoughts?
So 2 things I would say. One, with respect to our lending programs under Section 13.3, these are short-term lending programs that only exist because of a crisis and are done in conjunction with the U.S. Treasury, right? So these are very short-term programs. And they were meant to be that. We're not intervening in the markets in the long run. That is not, or even the medium run. It's very short term. And we're starting to peel those back as we speak. So I think we're not in that business. I don't think we should be in that business, except in the case of a crisis like we had. In terms of the broader issue, this gets back to the stress testing, the climate stress testing component, because the real loans are being made by banks. But increasingly in the US, and this is where it's also important to keep reiterating this, private equity firms, other players are in these markets as well in major ways. And so we don't regulate them at the Fed, but they are an integral part of this system, a very important part of the system, depending on the sector of the economy you're looking at, the dominant player in some cases. So there, we do need, again, this whole government approach to look at how we regulate, or if we regulate that activity. All that said, there's a broad consensus within the economic community that putting a price on carbon makes sense. Right? Exactly how to do that, the devil's clearly in the details. But get back to Steve's earlier point, if you can't measure it, you can't manage it. And an important component of the measurement is the price of carbon. Right? And if we don't have that, it's hard to get a lot of these other things done. That is not our job at the Fed. I'm just speaking for the broad economics community. This is something that is broadly supported in the economics community.
Thank you. And thank you actually for raising the issue of the other sources of finance that some of the polluting or dirty industries may have in the real economy, because that's something that came up also in the session that we had with the Bank of England and the Banque de France and the Banco Central do Brazil earlier, in terms of what can regulators do in terms of increasing the regulatory burden on the regulated agencies and institutions, which may then incentivize those industries in the real economy to seek funding from the unregulated part of the economy. So I don't know if there's more that you can say on that, on what your views are about how far you can go, because there is certainly high expectations to move with stress testing, with mandatory disclosures, the whole wish list that we've been talking about here. But is there a risk that changes the balance and that we still get financing for dirty activities from elsewhere?
Sure. I mean, there's always that risk. And so this is where we need, again, this approach of all the regulatory bodies that cover really the entire gambit of the financial system are involved. We really can't just do it at the Fed or just do it at the SEC. We really need to think about this collectively.
I agree. If I can just jump in on private equity for a second. First, I completely agree with everything that Patrick said. We did a report, so if anyone wants, they can go to the Ceres website, ceres.org, and the title is A Changing Climate of Private Equity, where we interviewed 27 of the largest private equity firms around the world, and kind of identify what they're doing. And there's a set of specific recommendations there. So and now we have a work group. We have the largest private equity work group, these are on a voluntary basis in the world, to come up with procedures. And there are some exciting things, but it's a combination of, we need to have voluntary action and we need to have regulatory action. And the SEC has less authority here than some of their counterparts in other countries. They have authority. So one of the debates in the US now, as the SEC prepares for their mandatory disclosure proposed rule, is how far to go on the private company side. Because there are folks all over, including Larry Fink, who has said that we shouldn't have these two rules because we don't want to shift the dirty investments to the private equity or the shadow banking. So there are a set of very specific recommendations in that report that people can look at. And if there are folks listening, we'd love to talk to people offline about this issue in greater detail.
Thank you. We're coming towards the end. I want to ask one last question to both of you, because we are having this conversation almost a month away from COP26, which is going to be a very big milestone in terms of making progress in a lot of these issues that we've discussed. So very quickly, what is on your wish list? What would you like to see? And what do you think is realistic to see? So President Harker.
Well, what I wish to see is practical steps we can take now, right? I mean, I think we're at the point where we need very practical steps that we can take as a global community and country by country to deal with what's in front of us. The time for big speeches is past. I mean, I go back to my engineering roots. This is time to lay out a plan and execute on it. It's not time to, and the plan's not going to be perfect. Back to Steve's point. It's never going to be perfect, but we need to start making progress here now. And the good news is, and I'm an optimist, the good news is, I think the private sector, the innovation we're seeing coming out of companies, out of university laboratories, is really exciting. But we need to get that stuff to market. We need to get the technology adoption process that we know all so well accelerated in a major way to get this technology deployed. And so that's one of the practical steps I'd like to see, is how to clear out the barriers to getting these technologies deployed. And again, I would put in that I don't think we can get there without some new innovation around nuclear power as well.
Thank you. Thank you, President Harker. Steve, your wish list and expectations?
So first, in the US, I hope that policymakers in Washington can come to terms on a budget package so that there can be clear identification of what the US will invest, whether it's the numbers being talked about today or some other set of numbers. There's a lot there that needs to happen. Second is, I completely agree with President Harker that we need to have concrete steps, science-based, year-by-year targets. So these 2050 goals are great, but they're aspirational. The people making them, myself included, aren't going to be here in 2050 probably to deal with it. So we also have to have 2025 and 2030 goals that are very concrete and show year by year, what's it going to do to your balance sheet? What's it going to do to your capital investments, your CapEx? What's it going to do in those areas? There needs to be private sector momentum, and there's a lot. Series is on the steering committee of GFANZ, kind of the global initiative, try to bring together all the financial sector. So it's investors through the net zero asset managers, it's Paris-aligned initiatives, it's insurance underwriters, so all those things, and more government activity. We do need innovation, and we need more investment, particularly investment to help those low and moderate income communities and countries that need that, so that again, we can make this investment, not have economic growth in countries that lead to more fossil fuel, more coal or things like that, but go right to solar. We have the technology, but it has to be scaled up, and looking at, we also have to be careful of that we don't fall back to the carbon offsets too quickly, that those should be an option of last resort, not first resort.
Thank you, Steve, and thank you both. We've covered a lot of ground today talking about just transition and climate migration, and both in the US and internationally, greenflation, reskilling and jobs, and stress testing and other regulatory tools that central banks have at their disposal. Thank you very much for joining us. I'll now hand over to the next closing keynote with Kirsten Dunlop, Chief Executive Officer at the European Institute of Innovation and Technology, Climate Knowledge and Innovation Community. Thank you very much to all our audience. Please stay on for the concluding keynote and ask questions as well. Thank you very much.